Well, welcome, JC. Thank you for joining me today, and thank you for taking time to talk about your book, and because it is a fascinating area and very timely in my view. So I'm going to start out today just with a couple of general questions about who you are as an author and sort of how you came to write this particular book. So, and then see where we go from there. So, just again to start out. So, tell me and tell our viewers who is JC de Swaan.
Sure, and first of all, Knut, thanks so much for having me on this. I really appreciate it, and I'm excited to have this conversation. And just by way of introduction, I divide my time between teaching at Princeton in the economics department, where I'm affiliated with the Bendine Center for Finance, and working in an investment fund. My background is that I studied public policy in graduate school, and actually went into management consulting. So I was at McKinsey for a number of years, and then moved to the buy side and became an investment professional. And but over time, and my initial focus was Asia. I invested across markets in Asia, and over time, I developed an increasing interest in issues around the economic development and the use of finance as a force for good in society. And my true passion is teaching. I taught as a grad student, and so I went back to teaching. And for the last 12 years, I've had this combination where I've been just enormously privileged to be part of the Princeton community. And there are a couple areas that I focus on. One is ethics in finance, so I created a course that I've been teaching for all this time. And the other area is Asian economies and capital markets, and I teach another course there.
Well, thank you. That's an interesting background. So, again, getting closer to the moment in time when you said, I need to write this book. Tell me, how did you start to teach the course that you do in Princeton, and that which sort of seemed to lead you to making this decision?
Right. So my entry point into the investment world, or my angle into it, was perhaps a little unusual in that when I think of my students that go into the buy side, most of them are obsessed with investments. Most of them, from a very young age, started watching markets, watching CNBC, trading their personal accounts and all that. I'm not like that at all. I came to it from a very different angle, which is having studied economic development, I was intrigued by this idea that finance could foster economic development. And so I joined a fund that was all about investing in emerging markets. But what was interesting about it for me is, this notion of allocating capital to its best use. And there was a lot of research starting in the 1990s and through the 2000s that showed that that had all sorts of positive indirect consequences on economies. And of course, as soon as I started as an investment professional, so I went into a long-short equity fund dedicated Asia, it took me about a couple days to realize that I would have zero impact on economic development. We were, we were just like trading shares amongst hedge funds and having barely an impact on market, and let alone on the underlying companies. And so I was, in some ways, it reinforced my interest in understanding, okay, like what part of finance can be a force for good? Like, what is it that I'm actually doing here? What's my function and role in society? and I started going through a systematic kind of approach and analysis of trying to understand this. And then I created a course. I started teaching. I created a course on ethics and finance. And what I noticed too over the years is that a lot of my students were keen to work in finance, but they were very concerned about being corrupted the minute they walked into their first job on Wall Street. And so that was another important angle to me, was to understand the conflicts of interest on Wall Street and to what extent those are driven by structural factors, to what extent is bad behavior or behavior that leads to bad outcome driven by behavioral dynamics as opposed to structural factors, and to what extent these two are connected. And so that's how I got to create this course on ethics and finance at Princeton.
Okay, that's an interesting sort of timeline there. You've been teaching the course now for several years.
Yeah, about a dozen years.
Okay. Do you remember after you taught it for the first time, sort of what you walked away from after the first semester thinking, that was really interesting. I had no idea, or something along those lines after your first semester of the course?
Yeah, I mean, actually, my first semester ended up being transformative in terms of the direction of my own research and the way I shaped the course thereafter. Because halfway through the first semester, I remember a woman coming to me, one of my students, and saying, why is it that we only seem to focus on unethical behavior? So it's a course on ethics and finance. And naturally, you're kind of swayed in that direction. And she said, why is it that we're not talking at all about constructive behavior? Like, why don't we look at the good in finance and try to understand the other side of the flip side of that coin? And I thought, of course, why is it that we don't talk about that? And so I set out to look for that literature, and I couldn't find any literature on individuals. There was a fair amount of research in the 90s and 2000s on the effects of finance on economies and on certain aspects of these economies and on society more generally, but there was very little written about individuals. And so what I did is I added a component to the course and essentially created a new strand of research for me, which was trying to identify remarkable individuals in the industry that we could learn from. But the way I set out to identify them was to try to find people that we could relate to, in the sense that they're self-interested, they're ambitious, they're often successful, but many each in their own way, but they manage to find a way to balance their self-interest with the collective interest. So they are the antithesis to the grab what you can when you can approach that we've seen increasingly, and just the broad self-serving. And so I researched both individuals and firms, and the project became not only a part of the course, but it became a book project. And that's the Seeking Virtue in Finance book. And ultimately, I wrote about 60 individuals and firms from which I tease out a framework. And the idea is that there's a lot that we can learn from these folks.
I'll come back to that a little bit later, but in the context of your seeking out examples of balancing or combining the self-interest with a common interest, did you delve into or look at data that answers the question, is there something unique about finance relative to other industries that put it in a different place? I mean, there have been obviously lots of successful companies in different industries. Do they have the same struggle, so to speak?
Yeah. So I mean, the question is there something special about finance that makes it an outlier versus other industries? And I think there is, from multiple different angles, right? So there's if you look at the economic research, I think you would find that there is more rent extraction in finance than many other industries. And so there's interesting research by Thomas Philippon at NYU Stern that comes up with estimates of the rent extraction in the finance industry, and it's extremely high, right? So that's one angle. There's another angle that would say, okay, is there something special about the finance industry? Well, yeah, if you look at the level of trust in the finance industry versus any other industry, at least in the US, and you look at your typical trust barometers like the Edelman trust barometers, the Gallup surveys, and so on, it's typically the case that finance comes in last, right? So out of 15 industries, finance is the worst. And then if you look at not only industries, but also like institutions, finance institutions come next to last after Congress, which is not saying much, right? And
okay.
Sorry.
Do you have a premise or a theory as to, and you could maybe you could write books on each of these questions, but in short form, why is it that finance comes in last?
Yeah, so this is not scientific, so it's not empirical research. My sense is that there are a few factors at play. One of them is that there's in the finance industry, there's particularly high level of complexity and a lack of transparency, opacity in the relationship between financial service providers and their customers. So that's these are two important points. There's a third point, which is that there's very significant asymmetry of information and of understanding of knowledge base between finance professionals and their customers. Yeah. Now, that is true of other industries, right? I mean, if you look at the spectrum, look, if you're a baker, there may not be that tremendous like dispersion of knowledge base, and there might, but there may not be that same level of complexity and opacity. But certainly in medicine, right? You might compare finance to medicine, and there you might say the same thing. But at the same time, and this is where finance might be different, is that finance can be a lucrative venture for finance professionals. A lot of finance professionals go into the industry for a number of different reasons, but it's often, it seems to me, a combination of intellectual engagement. They find it very interesting, and it is very interesting. But also the fact that you can earn a good living. Right. And I think that if you compare it to medicine, a lot of people go to medicine because it's fascinating, but also because they can help people, right? And so there may be something fundamental there that if you put all these pieces together, it's a little bit of a mosaic of data points, but that might point to why finance ends up being a little bit of an outlier versus other industries.
Good points. No, that makes sense. Let's move into your book and how you have sort of structured it. You've got 4 different themes, and I want to focus on the first theme. But why don't maybe you should just do a very high level brief description of each of these themes, and then I'm going to come back to the first one.
Sure. And the framework, I should mention, I tease out of the study of the role models. So I look at these role models, I spend a lot of time researching them. And the question I ask myself is, if you were to lead a virtuous life in finance, if you wanted to have virtuous behavior in finance, despite all the conflicts of interest in the industry and the norms and the incentives and so on. So taking finance realistically as it is today, not a notional finance industry, but the existing finance industry, what would it look like to be virtuous? And from the study of these individuals, I tease out a framework with 4 pillars. And the first one is to serve your customers with your customers' interest in mind. So to serve them faithfully, even when no one is looking. And of course, the challenge in finance is that it's often the case that no one is looking because so much of the information is going to be in the fine print and it's complex and so on, right? But that's the first one. And I would say that is the most important one because that is the professional mandate of finance professionals, is to serve customers. We're in the business of serving customers. We're intermediaries. So that is the first one and the highest one. The second pillar is the one that I feel the industry is not thoughtful enough about and could devote a lot more thing to, which is, and essentially it stems from a fundamental conundrum, which is that you could serve your customer well as a finance professional. You could fulfill your primary professional mandate, but you could do it by extracting value from the rest of society. And that's a problem because generally in finance, we don't generally discourage that and we don't track that. And because it's all about success in the way the industry defines it, then it's fine to be successful while extracting value from others. And so that's the part that is, I think, worth a lot more thinking. So that's the second pillar. The third pillar now looks inside the organization. And I would say probably in the hierarchy, I wouldn't put it as high as the first two because it's a smaller community of stakeholders. Now you're talking about your colleagues and your employees. Right. And it's this idea that in order to be virtuous, it's not just about serving your customers, and it's not just about not extracting value from the rest of society, but it's also about treating your colleagues, your employees with dignity, helping them develop, and promoting diversity within the organization and within the industry. So that's the third piece. Okay. Then finally, the fourth piece, and that's in some ways the one that's most fun, it was most fun for me to research, is to what extent are you using your skill set as a finance professional to serve society outside of your job, outside of your primary financial mandate. And it can be in parallel to your job, or it could be also after you leave the industry. And here I looked at all sorts of individuals that do interesting things based on a skill set that is frankly very versatile and very useful for the rest of society. Right. So that in a nutshell is the framework.
Good. That sets the larger picture. Okay, now I want to go back and I want to focus on the first notion, serving customers faithfully, and actually start with when you think of the word virtue. I see that you go back to its origins in the Western world in terms of how you think about it, perhaps. But is that in terms of how it's commonly thought of today? Do you have a sense for what the answer to that is? You ask the person on the street, what is it? What does virtue mean? Are those two meanings the same, or are they a bit divergent?
You know, I mean, virtue is such a loose term, and people will use them in all sorts of different ways. The way I thought about it is to, as you mentioned, derive it loosely from the original Aristotelian concept of eudaimonia. Yeah. And it's this idea that like virtues are what you would follow as principles of living in order to live a fulfilling life where you maximize your own potential and your potential to be a good citizen, right? And what I try to do is to say, okay, if you translated that notion to finance, what would it look like? And so as a result, the 4 pillars of that framework I think of as the virtues of finance. And so as a result, they're very broadly defined. And I stayed away from in normative ethics, often what you end up doing is looking at very specific decisions, saying, well, here's the dilemma, here's the conflict of interest, what'd you do? My approach is much higher level in terms of in the arc of a career, what would it look like to have been virtuous, having in mind that finance is complicated. It's full of conflicts of interest. The most virtuous people in the most virtuous firms are going to be faced with conflicts of interest all the time. And it's really hard to make the right decisions over time. But what are the high level guidelines that one may think about to guide broad, like important decisions at different points in time in your career?
Fair enough. So now to dig down into the notion of serving customers faithfully. The context in which I come to this question, as you know, JC, is the world of advice, more on a retail level, and in the context of the 2 basic models that we have out there, and we've had out there for generations and generations. The one sales model, otherwise referred to as the suitability standard or suitability model, has been carried out by brokers on the retail level, whereas on the other side we have the fiduciary model or approach that is that requires a lot more of a individual in terms of what is expected that individual do for a client. And as you know, you've already mentioned the field of medicine, doctors, lawyers, professionals are most commonly associated with the notion of a fiduciary standard of care. Now, so that to me is the framework. It's changed somewhat recently based on the regulators in terms of how they try to deal with it, but the basic framework doesn't change in terms of what we have out there. And you know, I think that's still there. We understand, and if we have a professional that we rely on and that we trust, be it a doctor or lawyer, it could be an architect, it could be other types of professionals. You know, we have one set of expectations, as opposed to when we go into a local store. We understand that individual indirectly or directly has an incentive to sell product, and that's okay, because this is what we expect and this is what we know. So there is a framework. Now, you've offered this notion of faithful service to customers, and it appears to be somewhere in the middle. You've referred to it as fiduciary-like, and you've put some meat on the bones in terms of saying what it is and what it isn't, and you have rightfully referred already a number of times to the significance of conflicts of interest in this industry, and I find it interesting in well, I mean, in many senses, but your sort of starting point of this is much more, I think, in the context of a finance firm that is dealing with either professional clients or institutional clients as opposed to retail clients. So immediately correct me if I'm wrong on there, but in terms of where your perspective might start, whereas my perspective starts far more on the retail side in terms of the world that the average Main Street investor deals in. So that to me comes into play. But so, for example, in terms of conflicts, you make a specific point in saying that it's not required of a investment professional to be faithful to advise a client that there's a better, less expensive product across the street that you might be interested in. You make a specific point on that, and that to me, from where I'm coming from, is sort of a red flag in a sense, because that's a significant point. That's a significant point. But it brings to me into mind the issue of what I was just referring to is, the nature of the clients that you are sort of presupposing. If they're a professional client, if they're an institutional client, they are in a different category. So my first question is, tell me how this is fiduciary-like when it appears there's an acceptance, a tolerance of dealing in this extraordinarily conflicted environment, and how do we overcome that to be faithful? Maybe that's one way to start the conversation.
So I mean, my basic starting point is very abstracted from current rules and so on, which is that one, as we talked about already, the finance industry lacks trust, right? So there's a fundamental problem. We also know that there are all sorts of ways in which finance professionals not only can obfuscate, but do obfuscate.
Yeah,
that's true whether it's at the retail level or the institutional level. And so the question is, what is the right approach? And my suggestion is simply teased out from various studies of role models, as well as bad cases, right? I do an entire case study on Wells Fargo.
Yeah.
And try to understand what happened at Wells Fargo, right? They created 3.5 million fake accounts, and that's extraordinary, particularly in the context of a firm that specifically positioned itself as the anchor of its communities. And that to me was absolutely fascinating. And what I take away from something like Wells Fargo or the situation in the US in general is that there tends to be a discrepancy between the implicit level of trust between customers and their service providers and the actual fiduciary standard by which they're beholden, right? And so there's a fundamental gap there that is problematic. And of course, in the US, we're very legalistic. So as opposed to say, if this conversation was taking place in the UK or in Japan, we would think of principles. But in the US, we tend to think more in terms of very precisely worded rules, which, is, I mean, unfortunately, that's the way our system is set up. So it's hard to get away from it. But I would say that, like, how do we think about what is acting on behalf of your customers faithfully? Well, one of the things I mentioned, which I think is teased out from a lot of these examples that I give in the book, is this idea that if you're going to sell a product, and if you're going to provide advice to a customer, then a simple rule is to try not to deviate from the kind of product that you would have sold to one of your friends or one of your family members, or the kind of advice that you would have provided them.
Right.
So that's the general idea. And then I think the real meat is going into the specific examples of the role models, whether it's in the hedge fund world, whether it's in the investment world to retail investors and so on,
Right.
and see what specifically they do as an
Right.
example to emulate.
You make a good point about our culture in America being so legalistic, but where I start from on this, and I'm sure some people think that I've oversimplified this, and that goes back to the 40 Act, and that goes back to the Supreme Court case in 1963, where the 40 Act is explained. And one of the amazing things to me about that case, JC, is you don't need to be a lawyer, I think, to really grasp what is being said there. The whole opinion is 16 pages. It's 4 pages of that opinion that sort of explains how do we come up with a 40 Act and why do we have it and what is it supposed to do. And it's, I suggest a good high school student can really grasp most of it. It's because it's not legalistic. And so, my starting point is to look at that as the lesson in terms of the world that I work in with retail and investors, and say, this was our grandparents, or great grandparents generation, and they really got it right. They really got it right, in my opinion, because what it comes down to is 2 things. You've got to separate in regulation sales and advice, period. And the second thing is you've got to avoid at all costs, all possibilities of conflicts. Bingo. But they were also smart to realize you can't avoid all conflicts. So anyway, that's where I come from in terms of looking at this, and and in terms of where I think it does make a difference between the institutional and the retail side is when you go down just one more level about dealing with conflicts of interest. And this comes up in one of the in at least a number of the early cases is, does the customer understand the nature of the conflict, and can you substantiate that? And again, it's not on a legal basis. This is really on a common sense basis. And one of the earliest cases that I like so much, they walk through that. And this is, in terms of what does that mean? So anyway, that's where sort of how I am approaching it, and that's where the issue of the sophistication of the client really does matter. And because you've got a different set of circumstances when you can say faithfully that the client understood the nature of the conflict and then shook the head and said, "Let's go." And so anyway, that's that to me is sort of key in terms of where I am. But and maybe that goes along with sort of your thinking and it's there, but I missed it. But anyway.
Yeah, and I would say, for me, when I look around the world and for models of, what I like as an approach, I like the Japanese approach that's been proposed by the FSA in Japan. And they proposed a fiduciary standard of care, universal fiduciary standard of care that applies to all finance service operators. So, and again, it would be hard to implement that in the US because we're very rules-based and legalistic. But I like the idea that you move away from being so precise about who has a fiduciary duty and who doesn't, simply because in the US, you have so many people that don't have technically, legally a fiduciary duty, but that position themselves as fiduciaries. And as a result, there is an underlying deception that is taking place, right? And so I like the Japanese approach, which is saying, look, we're in the business of serving customers, and you need to serve them by advising them in their best interest, and that's it. And now, interestingly, what they say is, we're not going to fine you if you don't do it, and so we're not going to go over it precisely with you. However, if you adopt a different approach, you need to write a memo at the end of the year, every year, to explain what you're doing that's different and why you're doing it. And that has kind of a self-reinforcing mechanism that's interesting, that they've used actually with their corporate governance reforms, their corporate governance code of 2015, that I think has been very effective. So that approach I like. And and I think it would have, I mean, in the US, it would resolve some of the issues where, if you look at the language that Wells Fargo used in its literature, in the way it dealt with its retail customers, it's so clearly positioned as a fiduciary. It's like they talk about relationship of trust and of confidence, but then technically there's only like a tiny subset of their finance professionals who are actually fiduciaries. And it's that discrepancy that's a problem.
Yeah. Well, and then I wonder this, that you're familiar with the research out there that on this precise point, because I think when you talk about positioning, the research which points out that in their marketing, there's so many firms that hold out, just as you say, that Wells Fargo does. On the other hand, on one hand, and then on the other hand, the same exact firms are fighting tooth and nail in legal proceedings of the exact opposite. Right. I.e., that they are salespeople at in an arm's length relationship, and there's no reason no basis for suggesting they are fiduciary. So we've got that phenomenon going on.
And I would say what's in some ways depressing about the state of the industry in the US is that I think for most people, you kind of assume that your financial service firm is not going to act in your best interest, and you kind of assume that the fine print is skewed against you. And that's why I was particularly interested in finding individuals where it's the opposite, right? So I found a guy who's a hedge fund manager, and when you go through his fine print, it is actually skewed in favor of his customers, even if its customers are not aware of it. And when I asked him, he says, most of the time they're not aware of it. But those are the examples to look at that I think would be interesting and could restore trust in the industry.
Well, on that point, then, what other individual example sort of comes to the top of your mind in terms of models that should provide teachable moments or teachable lessons?
I mean, so there are so many, but I don't think you can ever start a conversation about role models in finance, at least in the US, without starting with like talking about Jack Bogle, the founder of Vanguard. And I know obviously you're extremely familiar with him, but it's just the impact has been so phenomenal, right? And this idea that he set up Vanguard with the specific idea to sway individual savers to move away from actively managed funds to passively managed funds, which we know from the research since the early 1970s is the absolutely right thing to do. And it's still shocking that it took 40 years for the shift to happen in earnest. And so, someone who fought all his life and essentially put pressure on the entire industry to move in that direction, but not only that, to bring down their costs, whether they're actively managed or passively managed. I mean, that's extraordinary. And the only mark against Jack Bogle as a role model, I think, when I write about him, is that I think it's a little hard to identify yourself in him, just because he is so extreme, right? And there was something about him that was, in some ways, he was almost more of a public servant than a finance professional. And the fact, I mean, I think the best example of this is that he set up Vanguard as a mutual, and that in and of itself brought down the cost of his customers even further. Now, if you'd asked him, and I know you did, when he was alive, he always pushed back at the notion that he did it for, for public service reasons. But I'm not so sure, because I think his whole life was devoted to the collective interest.
Well, as you know, I've come to virtually the same conclusion, perhaps from a different journey. I look at the last 20 years of his life as his Teddy Roosevelt era, where he had no corporate responsibility per se, but such a strong passion, and he followed Teddy Roosevelt's model, I think, in some respects. But
So that's an interesting analogy.
But yes, no, I do happen to agree with you, and I think one of the lessons there, and you mention it sort of indirectly, is the importance of opacity, and the other way around, the importance of transparency. And I think so much of the passion for Jack Bogle was the Vanguard shareholders had a sense that he was telling them the truth, and he was telling them the whole truth, and he was doing it in a language that made sense to them. And on one level, it's extraordinarily simple, but on another level, it was so different from what else we were experiencing. We still experience that it made him stand out in a way that is just historic in nature. So.
Yes, and I would add to that. It's a perfect example of a firm that acts in the interest of their customers faithfully, even when no one is looking. And from surveys that the Vanguard customers trust their firm in a way that very few, if any, other customers trust their own.
And the contrast between that point with the Vanguard customers, as opposed to when this discussion happens by regulators about communicating with customers or clients, the first and last premise is investors are confused, and the unstated implicit reason is because investors don't get it. As opposed to what it should be is that the communications they're getting almost everywhere else is confusing at best and grossly misleading at worst. Anyway, so I think that's such a
So I would say Vanguard towers above the rest, but they're they are unusual because they are set up as a mutual. So there are a lot of other firms and individuals. I mentioned this hedge fund manager Andy Okun at Watermark, hedge fund he created after he left Salomon in the 80s. And that's just a remarkable fund where Andy and his co-founder literally said, I think the industry is self-serving. We're not going to go to the typical law firms to set up our terms and use the boilerplate agreement for our hedge fund investors. We're going to write our own terms on a blank sheet of paper based on first principles. And then the outcome is all sorts of terms that skew in favor of their customers and that are thoughtful, and that, and that's an interesting one because it's actually rare. I went to the heads of some of the largest prime brokerage groups in New York when I was doing my research over the last 5 years. I asked them, can you point to me fiduciary leaders in the industry so I can research them and interview them? And they drew complete blanks. They could not think of anyone. So you see it a little bit more in the asset management industry. You see firms that are interesting. So I write about Dodge & Cox. That's an interesting firm. And it came, I think here what's interesting is that they don't do any marketing. And it goes to one of Jack Bogle's important point over time. So Jack Bogle was an anchor of my seminar at Princeton. He came every year for 7 years until he passed away. And he said, for him, a lot of the investment industry, when he looked at them, he thinks that their core skill is not investment, it's marketing.
Right.
And because so much goes into marketing, they have to recoup these costs, and it gets passed on, of course. And Dodge & Cox is an interesting firm because they don't have the marketing costs, so they don't need to try to recoup these costs. And by definition, they're going to be lower costs, but they can focus on what customers actually hire them to do. And there are other firms like this. Capital Group, I think, in asset management, like fits that profile as well. There's the herbivore firms in Japan. So there are firms out there that we can look at for inspiration.
Good. That is good to hear. Listen, we're coming to the close of our time here, but just to sort of leave on a uplifting note, as you have done here in the last couple of minutes, especially I should say, looking to the future, what will come next, or what should come next in terms of moving the industry towards greater faithfulness?
Yeah. Well, first I would say we can observe that there are positive things happening in the industry, and I think the positive things that are happening in the industry probably come from the blowback from the global financial crisis. Right, the era-defining moment for the industry was really the global financial crisis, and that's when I think we shifted from a mode of thinking finance is a force for good anytime, and more finance is better. And after that, I think there was a lot of soul searching within the industry, but also like in academic research, saying, wait a minute, maybe that's not the case all the time. Maybe finance is a force for good, but beyond a certain threshold, it may have negative returns, and there are certain types of finance that may not be good, and so on, or helpful. And so since then, there's been a lot of dynamics in the right direction. One of them is a lot of the research has gone back to understand better what are the negative spillover effects from the industry and trying to address them. But the other thing is there are movements within the industry that are pretty remarkable. If you look at, one is the shift in asset management from actively managed portfolios to passively managed portfolios.
Right.
And that's a force for good. ESG, that's an incredible development. I mean, that's been an extraordinary development that has gained so much traction. This is, you look at it over the last decade, but just the last couple of years when you see the inflection point. And I think now, and it may be a function also of the pandemic and how shocking of an event it's been, and how tragic of an event it's been, and then of course the death of George Floyd and the surge in indignation around racial inequality. I think diversity is going to be like an important next step in the industry, and in terms of something that moves in the right direction. Now, what are next steps? I would suggest one is greater awareness of the impact of finance on society. So my book is a very modest contribution, and it builds on a lot of research that is emerging research. It's new type of research that is not only looking at the extent to which financial firms serve their customers well, and I think that research has improved because it's going deeper into understanding the fine print and the impact on the fine print and the way in which a lot of financial firms specifically target vulnerable population and target their vulnerability. But beyond that, there's just a lot of greater awareness that needs to take place around what are the positive and negative spillovers of the industry, and how is it that you can serve your customers and yet extract value from society? How can we make sure that when we serve customers, we actually do it in a way that is at least not extracting value from other stakeholders? And so I would say greater awareness, greater discussion of these topics, more research. I think the research on role models is an interesting one, and it'd be great to see more of that. And I think, I'll just leave with that one note that I've been thinking about, which is not part of the book, but I think it may be the next step in my area of research is checklists, because what you find is that a lot of the bad outcomes in finance often come from the fact that you have good people who are very sophisticated and very smart making decisions in ways that are completely oblivious to their one, moral component, and two, consequence on the rest of society. And that is in large part due to the fact that the industry is fertile grounds for cognitive biases, more so likely than other industries.
Yeah.
And how do you address cognitive biases? Things like, these concepts of bounded awareness and motivated blindness and so on. Checklists may be the next kind of wave of things that we should consider for the industry, because if you had checklists when you made big decisions on behalf of your customers and you actually wrote them down and they were part of a record, I think it would go a long way towards making sure that you explicitly embed some important aspects of collective interest into your everyday decision. So those are my suggestions and for next steps.
Great, very well, sort of bringing this to a head. So JC de Swaan, thank you very much for your time. We'll get it up on our webinar. I will write my op-ed on it next week and go on from there. I'm going to turn off the.
Great. Well, thank you so much, Knut, for hosting this, and I very much enjoyed our discussion.
I'd like to follow up offline just for a minute after I turn this
Sure.
off. Okay.